Question of the day. Can you only use your VA loan only once? The real answer to this question is there's multiple ways that you can use your VA loan, but it's definitely you can be used more than once. See, a lot of individuals believe that they only can use their VA loan one time to purchase their dream home, and that's simply just not the case. So the VA actually only guarantees 25% of the loan purchase price for every home that you actually purchase off of your certificate of eligibility. Now, the VA only says that you can only at a max have 2 homes on your certificate of eligibility at one time. That's the catch. Only at one time, 2 houses on your certificate of eligibility. Now, we're going to break down in this video how that actually works and how that pertains to you today in this video. So I'm going to give you 2 examples. I'm going to give you an example of you just using your VA loan, and then I'm going to show you the caveat behind that and how we helped one of my clients last year purchase her second home, her dream home, after and turning her first home into an investment property. Let's talk about it here and let's get directly into it. So let's talk about the original home, okay? That's what we want to focus our attention on first. We want to focus on, so let's say in 2020, you decided to purchase a home under your VA loan for $250,000, okay? Now, just to keep this rational, we're going to come up with a payment as well too, just to kind of outline this a bit more. I don't know why that is so thick. I don't like my ink that thick. All right, so payment, that's better. All right, so payment for this home, let's say that payment is $1,350, and I think that's high in 2020. Maybe let's go $1,100. Okay, $1,100. That's probably more likely in 2020. Now, the VA only guarantees 25% of the agreed upon loan price, okay? Loan that you actually purchased a house for. So 250 times 25% is actually $6,250. So in this situation, on that $250,000, the VA is telling the bank they're only going to guarantee $62,500 if for some odd reason you was to default on the property, okay? Now, you can default on the property, and here's a little insight. If you were to foreclose, which I hope you never foreclose on a property, but if you were to go into foreclosure, that 25% is basically becomes dead weight, because now the VA has paid that out on your behalf to the bank, and you can never receive that 25% back as long as the VA is still in debt on that 25%, okay? So basically you will only have 75% of your eligibility left, but you still can use your entitlement yet again if you qualify, all right? So that is just a little caveat there, but that's not what we're here to talk about. Now, so that $250,000 is only guaranteed to have $62,500 guaranteed by the VA for some odd reason if things go awry with the property that you just purchased. Now, let's say in 2024, well, before we get there, so the good thing about this is that you have a property, you have an asset. You have an asset that's paying $1,100 in payment that you're making every month versus giving it to a landlord. That is the thing that a lot of people forget. When you're paying your mortgage, you're actually paying your mortgage to yourself, technically to a lender, but technically you're building equity in the property. And as the equity grows in that property, you are still controlling the asset. Now, the reason why I say that, because in 2020, as you're aware of, we've seen a lot of price acceleration. So in my mind, a $250,000 house from what I've seen on the market lately is at least on par now with being around $315,000 to about $340,000. Just depends on the neighborhood, the amenities in the area, the school districts. A lot of these things play a role, but theoretically you can have an asset that you've had in your possession for 4 years, going on 5 years now, where you can actually see a net positive in equity. Let's just run the numbers. 315 minus 250 is 65 grand in equity, or 340 minus 250 is 90 grand in equity. Okay, So you could have somewhere between 65 to 90 grand in equity, a home that's actually valued at somewhere around 340 or 315, and you decide, one day you pick the phone up and call Craig and say, Craig, I want to purchase my dream home. Okay, and let's talk about that for a second. So last year we had a client who actually picked the phone up as a referral, and decided that they really was interested in purchasing another home. And once they decided they wanted to purchase another home, we ran through the scenario. Okay, do we need to sell the house? She didn't want to sell the house. She wanted to keep it as an investment property. Cool. Okay, well, that's going to limit how much you can actually how much of your VA loan you can use. Well, what does that mean? Well, the VA has a thing called a conforming loan limit. Okay? A conforming loan limit tells lenders how much they can actually loan on the behalf of the VA to a veteran or a veteran service member entitled to it, or active duty service member entitled to it, however you want to look at it. How much they can actually loan up to without the service member having to bring a down payment. Remember, the VA home loan, one of the best products on the market, allows for you not to have to make a down payment as part of the reason for the entitlement. With that, if you go exceed the conforming loan limit, which in 2025 the limit is $806,000, you have to make a down payment for anything above that. Okay. But if it's at $806,000, which that's a lot of house, especially in the Hampton Roads market, you don't have to worry about that. So in this situation, our client wanted to purchase a home without actually having to sell their condo, because they wanted to rent the condo out for residual income as a retired service member. Perfect plan. I think this is a great idea. So our lender works this out to where, okay, this service member could potentially do this. Here's how we found out how much they qualify for. Okay, you simply are going to take the original loan amount that was guaranteed, $250,000. We're gonna call this the old loan. Okay. And that's going to be $556,000 left. Okay. Now, the service member is entitled leftover. This is called leftover entitlement or secondary entitlement, however you want to look at it. But service members have this left over, or some form of this amount left over of their certificate of eligibility. So this means that our buyer who's desiring to purchase their dream home has up to $556,000 to actually use. So how does that work? And why is this important to know? And let's show that. Okay, so basically they went shopping on 556 and purchased a home for $480,000 with 0% down payment. And by the way, let me just move this sheet over a little bit so that way you can see. I'm gonna write that again. So we had 556,000 leftover entitlement. And they purchased the house for $480,000 because it's underneath their entitlement that they had left over. Still had 0% down payment. Okay. So this saved them anywhere between, if it's 480, anywhere between 16,800 to 24,000. And I came up with these numbers because these are the figures for a FHA down payment or conventional down payment at the minimum of 3.5% or 5%. Okay. Now, but on top of that, this service member obtained a disability rating, okay? So now they don't pay the VA funding fee, which on their second use case, second VA loan funding fee is actually, the second funding fee is 3.3%. So then they saved an additional 3.3% that they did not have to pay on that $480,000. So that 3.03, that's an additional $15,000 that they did not have to pay, okay, in funding fee. And we had the seller cover their closing costs, okay? So the seller gave them 3% in closing cost commissions, okay? So they actually had no closing costs that they had to pay out of pocket assistance. So they received another $14,000 in from the seller to close on the property, okay? From seller. So our client wind up buying a house for $480,000, having a closing cost associated with the property. Closing costs of $14,400 get paid by the seller. No funding fee because of disability rating. The VA says if you have a service-connected disability, they waive the VA funding fee, and that shows up on your certificate of eligibility. But then also, so they had no percentage on that, and they actually, so which would save them $15,840, and they didn't have to bring a down payment, which could have been anywhere from $16,800 to $24,000. And on top of that, their service-connected disability rate made them eligible for property tax relief. So their property taxes on their home was $4,000 plus that they did not have to pay annually. Now, this is your second use entitlement that happened with this service member. Okay? Second entitlement. So, remember we talked about the service member had an original property, okay? So, remember we said, let's just say that property was $1,100 a pay, okay? So, let's talk about that. The first house is $1,100 in mortgage payment. Okay, then let's say the second house, I don't remember how much that mortgage payment is, but if we were talking about $480, let's just call $480. Even if we use today's dollars, it was last year. Let's call that payment around $2,500. Okay, let's say it's $25. It may be a little bit less or a little bit more, but let's call it $25 for the mortgage. Okay. Well, they purchased this house, the original house, so long ago that the rent demand for the first house is $2,300. Okay, this is how much they're making in rent. Okay, so they are netting $1,200 a month. Okay, so if we was to take that $1,200 and apply it to the mortgage of the second house, they're only paying $1,300. And this is why I think a lot of people are unaware, and service members should become more aware of the entitlement use that you have for your VA loan. Now, there are stipulations. This is why you got to speak to your lender about how to step up and step down and how to use the second entitlement. It just can't be because I want to have an investment property. No, it has to be where it fundamentally makes sense for you to have the upsides if you're in the same city or the same community or the same within 50 miles of the same location that your original property is. If your family grows, of course, you should be entitled to use your second use. If your family becomes smaller and you bought a bigger house, now you want to go down to a townhouse, condo, ranch style house, whatever. Of course, the entitlement just has to make sense, but this is why you need to speak to your lender about that portion. I'm just giving you the tools so you can be armed enough to understand a lot of this information to be able to do the right things with this information. If you have questions or concerns, I want you to use our link down below to book a call, shoot us an email, or give us a call to where we can actually help you through this process as well too. Feel free to reach out to us any and every time. We don't have a problem with that. Now, but let's talk about it. If you only have to pay $1,300, okay, for both houses, for both assets, because your tenant is paying the original asset that you had, the $1,100, by paying you $2,300 to live in that same unit, and you're paying $1,300 because you're using your return on your investment from your rental to minimize your mortgage impact for the second house of $480,000. Remember, this house is $480,000 when they purchased it. Okay, now that house may be worth now today in real dollars. Okay, in real dollars, the $480,000 may be worth anywhere from $515,000 to $520,000, but we're going to use $515,000, okay? And then the $250,000 house that they originally purchased may be worth $335,000 to $350,000. Tell me this, $350,000, okay? Tell me this, who wouldn't want to own $335,000 plus $515,000, $850,000 in assets by only paying $1,300 a month for them? That is it. This is how this process works. Now, to give clarity to this conversation, now we are dealing with a higher interest rate environment. My client who bought the $480,000 house was dealing with a little bit slightly higher interest rate environment, about 4% at the point in time. But the original house that she got for the $1,100 or so was about a 2% interest rate because they refinanced to that. But this is the formula is still the same. You want to control the asset if you possibly can, and the VA loan gives you the opportunity to not only use your VA loan but once, but twice at any single given time, and you can always go up or go down, but control two assets, and you are allowed to rent out one of the assets. So to me, this is one of the best use cases of the VA loan. And yes, you can use your VA loan more than once, and you actually can use it twice. If you found value in this content, go ahead and hit me with a like, go ahead and subscribe to the channel, ring the notification bell, and comment down below. Have you used your VA loan more than once? And if you have, did you go up or did you go down? I'll catch y'all in the next video. If y'all ever have questions or concerns that we can help you with, feel free to check out our links down below where you can reach out and contact us, and I'll catch you in the next video. Y'all stay safe. Peace.